August 17th, 2022. Somewhere in a trading room, a screen refreshes, and a name flashes across it that every Reddit investor in America recognizes. Ryan Cohen has just sold his entire stake in Bed Bath & Beyond. Within hours, the stock that thousands of retail traders had piled into loses nearly 60% of its value. And a story starts writing itself. The billionaire who pumped a dying company, then dumped it on his own followers. That's the story you've probably heard. It's the story most videos about this collapse tell. It's also, at best, half of what actually happened. Because by the time Ryan Cohen ever bought a single share of this company, it was already being bled dry by a decision made 18 years earlier, one that had nothing to do with him.
So here's what this video is actually going to answer. First, was Bed Bath & Beyond already a dead company walking before the meme stock crowd ever showed up? And second, if that's true, why does almost nobody tell the story that way? Stick around, because the real villain in this collapse isn't who you think, and the number behind it is bigger than anything Ryan Cohen ever touched. Bed Bath & Beyond opened its first store in 1971 and spent the next 3 decades becoming what retail analysts called a category killer, a store so large and so stocked that it buried smaller competitors just by existing. By the 2000s, it had become one of the most dominant home goods retailers in America, the kind of place where a 20% off coupon felt like a birthright.
Then, in 2004, the company started buying back its own shares. On paper, this looks harmless. A company with strong cash flow repurchases stock, reduces the share count, and in theory, increases the value of what's left. Plenty of healthy companies do this. But Bed Bath & Beyond kept doing it, year after year, long after the fundamentals of its business started cracking underneath. By 2014, the company had gone from spending its own cash on buybacks to actually borrowing money to fund them, taking on $2 billion in debt specifically to repurchase stock. This is the moment worth sitting with. A retailer facing early warning signs from e-commerce competitors chose to go into debt to prop up its share price instead of investing that capital into stores, technology, or supply chain. Over the following years, that buyback total kept climbing until it reached the full $11.8 billion, spent entirely on shares, while the stores themselves aged, underinvested, and gradually fell behind Amazon, Target, and Walmart, all of which were pouring billions into e-commerce and logistics during the same window.
By 2019, the cracks were impossible to hide. The company posted its first annual loss in nearly 3 decades as a public company, and a group of activist investors forced out longtime CEO Stephen Tamaris, ending a 16-year run. In came Mark Tritton, a former Target executive, hired specifically to modernize the brand. Tritton's diagnosis wasn't wrong. Bed Bath & Beyond stores were cluttered, its brand assortment was stale, and it leaned too hard on national brands and coupons instead of building anything proprietary. His fix was to pivot hard into private label products, store-exclusive brands the company designed and sourced itself, which typically carry higher margins than national brands. The execution is where it fell apart. Private label requires a mature, well-built supply chain to develop products, manage vendors, and get inventory onto shelves reliably. Bed Bath & Beyond didn't have that infrastructure, and Tritton tried to build it in roughly 2 years during a global pandemic that was simultaneously breaking supply chains for every retailer on Earth. Customers walked into stores looking for the brands they'd trusted for years and found unfamiliar private label products instead, while national brand vendors, feeling sidelined, pulled back their own shipments in response. And in the middle of this identity crisis, with sales falling and the company visibly struggling, leadership authorized another $675 million in stock buybacks in late 2020. By 2021, with comparable sales already declining, the company accelerated that spending further, burning through roughly $1 billion in cash on its own shares in under 2 years.
Liquidity that could have stabilized inventory or reassured nervous suppliers went instead toward supporting a stock price that kept falling anyway. This is the environment Ryan Cohen walked into in March 2022. Cohen, the co-founder of Chewy and chairman of GameStop, disclosed through his firm RC Ventures that he'd acquired roughly a 10% stake in the company. He sent the board a letter criticizing leadership's performance and pushing for major changes, including exploring a sale of the company and spinning off the profitable BBBY baby chain. Bed Bath & Beyond's board agreed to seat 3 RC Ventures picked directors to avoid a bigger fight. Retail investors on Reddit and YouTube treated this the way they'd treated GameStop 2 years earlier. Bed Bath & Beyond became a meme stock, its price swinging wildly on social media momentum rather than the company's actual financial health, which by every internal measure was deteriorating. Then, in August 2022, 5 months after taking the stake, Cohen's firm filed paperwork disclosing it had sold its entire position, nearly 9.5 million shares, over 2 days, during a spike in the stock price driven by that same retail trading enthusiasm. The filing became public after markets had already reacted, and the stock lost close to 60% of its value in the following days as the retail buyers who'd piled in were left holding a falling stock. Did Cohen time that sale using information other shareholders didn't have? Shareholders certainly thought so, and multiple lawsuits followed accusing him of exactly that. But here's the twist almost nobody covers. Those lawsuits never actually got a verdict on the merits. When Bed Bath & Beyond's bankruptcy plan canceled every existing share in 2023, a federal judge ruled in June 2024 that the shareholders no longer had legal standing to sue. Their claims were dismissed as moot, not disproven. A separate argument that a moon emoji Cohen posted amounted to securities fraud was rejected outright as too vague to count as a real statement. The SEC also opened its own inquiry into Cohen's trades, and that inquiry has not produced any public charges, fines, or settlement against him. In other words, the question of whether Cohen did anything wrong was never actually answered. It was erased by the bankruptcy before anyone could answer it.
What isn't erased is what happened next. Bed Bath & Beyond's business kept collapsing under the weight of years of underinvestment. The quarter after Cohen's exit, losses widened by over 40%, and sales dropped by 1/3. Suppliers, already wary from the private label disruption, tightened terms further, demanding cash up front instead of standard payment windows, which meant even less inventory made it onto shelves, which meant even lower sales. In a spiral the company never broke. By early 2023, Bed Bath & Beyond was closing hundreds of stores, exiting Canada entirely, and scrambling for emergency financing. A $1 billion rescue deal fell apart after raising only a fraction of its target. On April 23, 2023, the company filed for Chapter 11 bankruptcy. Within months, its remaining assets, mostly its brand name and web domain, were sold to Overstock.com for just $21.5 million. A company once worth over $17 billion at its peak ended up selling for less than the cost of a single Manhattan apartment building. So who actually killed Bed Bath & Beyond? The honest answer isn't satisfying, because it isn't one person. It's 20 years of a board and executive team choosing to spend money supporting a stock price instead of building a business that could survive a bad decade. Ryan Cohen didn't create that problem. He arrived at the very end of it, made a large profit off a stock that was already artificially inflated by years of financial engineering, and became the visible face of a collapse that had been under construction since before most of his followers were watching the ticker. The lesson for anyone building something of their own isn't about meme stocks or activist investors. It's about what you do with cash when things are still going well. Bed Bath & Beyond had the money for years to reinvest in the parts of the business that actually kept customers coming back. It chose to spend that money
making shareholders feel good in the short term instead. By the time it needed that money to survive, it was gone. If you're building anything right now, a business, a side hustle, a brand, the version of that lesson that applies to you is smaller but just as real. Protect your reinvestment capital before you protect anyone's short-term comfort, including your own. Because the moment you actually need that cash is never the moment you expect.